Now, emerging markets might not sound as fancy as AI or US tech stocks, but according to the Association of Investment Companies, they were actually one of the best performing asset classes last year, up around 30%. We're talking countries like China, India, Brazil, economies growing rapidly, but not yet considered fully developed markets. One way to get exposure is through ETFs, or exchange traded funds, which allow investors to buy a basket of international shares in one simple trade. So are emerging markets the opportunity investors can't ignore? Andrew Wielandt is the Director of DP Wealth Advisory and he joins me now. Andrew, how are you? Good to see you again.
Thanks, Koshy.
Why do you think we should be considering emerging markets?
Oh, Koshy, there's lots of reasons to be thinking about emerging markets, and I might just pick you up on what you said before around the AI piece and, the fact that it certainly is an exciting investment trend at the moment, and whether emerging markets could be another way of thinking, another option of looking at it. I'd actually say that AI is actually one of the reasons you would think about emerging markets.
Why?
Because you've got exposure to a number of different economies that are really focused on that AI piece, South Korea in particular, and the chip manufacturing that's going on there with the likes of Samsung or SK Hynix. And one of the reasons to that 30% return that you just spoke about, because of this insatiable demand for chips at the moment. There are other reasons about emerging markets we can talk about in a second, but just on that AI piece, there's huge opportunities in those emerging markets. One of the reasons why they're kicking along this year.
Okay, a lot of people avoid them because they think emerging markets are just all over the place, too volatile, you can't predict.
As they have been.
Is that right?
As they have been.
Right.
But there are a couple of compelling reasons you really would think about looking at emerging markets. The key one being, Koshy, is simply the fact that they are growing much quicker than the Australian or developed world. On average, an emerging market economy is growing at 2 to 3 times per annum the rate that Australia is, because they have significant population growth that's taking place, ex-China, and you've also got that industrialisation that's taking place as well. So it is, to your point, an area we've been very much focused, we as an investment community have been very much focused on, the US in particular. And if you look at the broader index, it's about 76% US, lesser degree Europe, lesser degree Japan, as we should do. However, there really is an opportunity for investors with their portfolios to be thinking about emerging markets.
All right, you need help in emerging markets because you can't follow them pretty closely. Information's hard to get. So this is where ETFs come into it, 100%, don't they?
100%.
They do all the decision making for you. Give us 3 ETFs that would give you a good balanced exposure to these.
So the first one we're going to talk about is from Beta Shares, BEMG it's called, and it basically just follows the Emerging Markets Index. So as I said before, there's a MSCI, the Morgan Stanley Capital Index, they basically just have a basket of companies and countries, and Beta Shares gives Australian investors an opportunity to invest in those. And you have countries like China, you've got countries like Taiwan, you've got countries like South Korea, and you have names in there like Tencent, Alibaba, etc.
All right, number 2.
So number 2 is a tweak of that. It's from JP Morgan. It's called GEME, J-E-M-E. So again, following that same index, same management fee, but what you're getting in addition to that is you're getting JP Morgan's research. They've got a number of analysts on the ground in all of these countries and saying, well, the analyst is sitting in Indonesia, well, I think this investment might be okay.
Right.
Or the Chinese one might be saying, well, I think this might be a little bit overvalued. So it's not huge changes, it's just little tilts, little tweaks, but for the same management fee, you're getting a slight level of active management and a reasonable performance as well.
Okay, number 3.
Number 3 is called E-Market, EMKT. And so what it's doing is it's looking at the universe and saying what particular countries or companies offer value. So as an example, the index is 18% South Korea. So back to our friends at BEMG, 18%. In the case of EMKT, it's 26% South Korea.
Right.
Because they've looked at it and said, well, we think Samsung trading at 8 times earnings is super cheap, or SK Hynix is good value. And it's returned about 34% over the last 12 months relative to the indexes, which was returned 30.
So it's a bit more active.
But at double the cost. So you're basically saying, do I want a passive approach, follow an index, Or do I pay for the smarts of E-market, and some years it's going to be great, like last year. There's going to be some years where, you know, their tilts won't be correct. And that's really the whole active versus passive piece. That is for another time, Koshy.
Yeah. They're three really good mix for your portfolio. But in terms of your overall portfolio, what percentage should be in emerging markets?
Around 5 to 7% should be, you should consider using emerging markets in some form.
ETF's a good way to do it. Andrew, good to see you again, mate.
Thanks, Koshy.